Yeah, these are dangerous times for oil markets at the moment. It's hard for anyone in that market to really gauge kind of the direction when you look at the amount of geopolitical risk that is out there now. Of course, we haven't seen that reflected in the price up until now. I mean, the backdrop to this is literally hundreds of attacks on oil shipping, on shipping going through the Bab el-Mandeb Straits. This has been a key narrative over the last 2 years, and it hasn't really moved the dial in terms of oil prices significantly over that period. We're still languishing as we are now around $75 a barrel for dated Brent. So, and that was the close yesterday. Where is the geopolitical risk premium? And, we've seen these near unprecedented events with Israel and Iran, these tit for tats, exchange of missiles, of attacks on each other's assets. And we're not kind of seeing that in this big, spike in prices. When you track back to the attack on Abqaiq oil facilities in Saudi Arabia, that triggered a $10 a barrel surge in intraday prices. We haven't seen that sort of volatility yet.
Let's talk about the supply that's coming from Iran. That's roughly 4% of global supply. If some of that is disrupted, if the Strait of Hormuz is disrupted, where would you be seeing the oil price?
Yeah, well, I think that, any sort of attack on Iran's oil producing facilities, its refineries, it's the knock on in the region. Iran is a big supplier of transport fuels, for example, into Iraq. It's a big supplier of natural gas into Iraq. Without that supply of fuel and natural gas, Iraq can't run its power stations. Petrol pumps go dry. And that's a big problem for the Iraqi government. But importantly for OPEC, it means that it's very difficult for Iraq to adhere to its production quotas and its compensatory cuts. So there is a big knock-on effect within OPEC to any attack on Iranian oil refinery infrastructure that could come from this by the Israelis in response. In terms of export markets, as Jeff Curry said, the market is looking into next year at a glut. We still have 5.6 million barrels a day of idled OPEC capacity on the sidelines. Saudi Arabia probably wants to bring as much of its oil back to the market as possible. So, any disruption to Iranian supplies to the international market, I think could probably be made up by OPEC's spare capacity and its idled oil at the moment.
All right, that makes a lot of sense given the amount of spare capacity when it comes to the Middle East there. Andy, I want to have you comment on some of the comments coming from the Saudi minister just now. He warns of $50 oil as OPEC Plus members flout production curbs. Obviously, this is very much a veiled threat. Hey, we're going to be starting a price war if you don't stick to the rules. Are we going back to 2014?
We could be. I mean, the data speaks to itself, that Saudi has been squeezed in its core markets, and it's been squeezed by Russia, its main partner in the OPEC Plus alliance. That Russian crude that was displaced from its traditional European markets, that's flowed into Asia, it's flowed into China, it's flowed into India. These were markets that Saudi Arabia effectively owned with its major Gulf partners in OPEC. That all changed when Russia invaded Ukraine and we had the imposition of sanctions. So, yes, Saudi Arabia has problems with compliance within OPEC, primarily countries like Kazakhstan, Iraq. However, it has a bigger problem in terms of Russia, and that's what we're not really talking about now. It's Russia that's really taken that market share from Saudi Arabia in countries like China and India, which are still the big drivers for the oil market.